Most people believe their CPA is planning their taxes. In reality, they're reporting what has already happened. By the time you hand them the documents at the end of the year, it's too late to change the result. By planning for your 2027 taxes, you should start now. Welcome to episode 15 of Investing Outside the Box. I'm David Harris, a fee-based fiduciary at Alternative Investment Advisors, and I work with high net worth investors who want real planning, not generic market commentary. Let's start with the biggest myth in tax planning. Most people believe their CPA is planning their taxes. In reality, most CPAs are reporting what has already happened. And by the time you hand them the document at the end of the year, it's too late to change the result. So if you think planning begins after the year is over, that's the trap. Plan your 2027 taxes, and that should start now. If you're a high net worth investor and your income includes K1s, bonuses, RSUs, rental income, or significant capital gains, this is for you. High income creates opportunity, but it also creates complexity. And complexity is where money gets left on the table. Let me be clear, your CPA is essential, but your CPA generally can't change the inputs after the year is over. Inputs are your income mix, the timing of gains, your deduction profile, or how your portfolio is structured. That's why planning early matters. 2026 and 27 planning is also changing because tax rules and thresholds have shifted. For example, the standard deduction for married couples filing jointly is now $32,200. And there's a major lever back on the table that matters specifically in the alternative investment world. 100% bonus depreciation for eligible properties. In plain English, in certain alternative funds that own depreciable assets, depreciation can be passed through to investors on a K1. And when 100% bonus depreciation applies, deductions may be accelerated into the current year instead of spread over many years. Not every fund qualifies, and it's structure dependent, and it's also suitability dependent. But that's exactly why planning can't wait until the end of the year. So quick note, this is for educational purposes only. Consult your tax professional for advice specific to your situation. Here's how I simplify planning for high net worth investors using alternatives. 2 outcomes and 1 overlay. Outcome number 1, income offsets. Certain real estate and energy strategies can create deduction profiles that may help offset certain types of income. And in some structures, depreciation can flow through on a K1. The goal isn't a product. The goal is an alignment of legitimate deductions with the right tax plan early enough for it to matter. Outcome number 2, gain management. If you have large capital gains, selling a business, selling property, trimming concentrated stock positions, tools like opportunity zone planning can potentially change the timing and long-term tax profiles of those gains. Timing matters, suitability matters, but proactive planning changes results. Now the overlay, tax-aware portfolio design. We look for preventable tax friction, unmanaged gains, unnecessary distributions, poor timing. So your portfolio isn't actually creating a bigger bill. Now here's the real unlock for most high net worth families. It's the advisor gap. Most high net worth investors have a good CPA and a solid attorney, but those professionals often work in silos. My focus is on the middle ground, ensuring your alternative investment structures, the private equity, the real estate, the energy sleeves, are actually talking to the tax plan. We aren't looking for one-off wins. We're looking to build cohesive architecture where your investment and your tax obligations are aligned. Let me show you this visually. On screen is a simple triangle, CPA, attorney, portfolio. Now look at the center. That's me, your fee-based fiduciary advisor. The arrows matter. They point outward from the center to each corner because the value isn't that you have smart professional. The value is that someone is coordinating a strategy so the CPA isn't operating in isolation, the attorney isn't drafting in a vacuum. and a portfolio isn't investing without tax intent. Most people have the corners covered. The savings happen when the center is covered. So here's the action step. If you want your 2027 tax outcome to look different, you have to start now. Schedule a short introductory call with me, and I'm happy to work directly with your accountant collaboratively. So we're not competing with trusted relationships, we're enhancing them. We'll identify what levers you actually have, which alternative strategies may fit your situation, and what needs to happen early before deadlines remove your options. In my 30 plus years of doing this, I've seen millions of dollars being left on the table simply because the conversation happened too late. Your CPA files the return. My job is to help you shape what the return will say before it's too late. Thank you for watching today. I look forward to seeing you next week when we'll explore practical ways to reduce taxes, pursue long-term appreciation, and avoid the 60-40 illusion by using alternative investments.